Let's talk about what's ahead for investors in 2026. The stock market just wrapped up another impressive year. It's the 6th time in 7 years we've seen double-digit gains. And while strong returns are always welcome, they often bring new questions. So when markets hit record highs and valuations climb, it's natural to wonder what comes next. What's the good news here? We're seeing something that hasn't always been true. Multiple parts of the market are working together. And so let's talk about what I mean. For years, U.S. stocks dominated everything else, but in 2025, international stocks actually outperformed domestic stocks for the first time in quite a while. Both developed international and emerging markets rose, about 30%. Even bonds did their job providing stability and generating positive returns as the Fed continues to cut rates. This diversification matters. It's a reminder that staying balanced and aligned with your financial plan tends to work better than chasing headline news and kind of the hot topic out there. Now, let's address the elephant in the room. Stock valuations are high, really high. The S&P 500 is trading around 22.5 times earnings, getting close to the dot-com bubble levels. Now, we're not there yet, but we're close. Here's what that means and what it doesn't. High valuations don't predict a crash tomorrow. Markets can stay expensive and elevated for years, but they do suggest more modest future returns and greater sensitivity to disappointments. When markets are, quote, priced to perfection, even small misses can trigger volatility. So what's the key? We want to be selective and balanced across different market segments, and that becomes even more important as earnings multiples and valuations become more and more extended. Artificial intelligence continues to be the story that everyone's watching, and for really good reason. Capital expenditures on AI infrastructure exceeded trillions of dollars in 2025. We're talking about data centers, GPUs, and massive hiring. But here's the interesting part. Business adoption is accelerating. Census data shows the percentage of companies using AI doubled from 4% to 10% in just 2 years, and that's just the beginning of where we are. For investors, AI presents both opportunity and concentration risk. The Magnificent Seven tech companies now make up about 1/3 of the S&P 500, and most portfolios then have significant AI exposure, whether you realize it or not. So think about that for 1 second. 1/3 of the S&P 500 is made up by 7 companies. That means that those 7 companies are taking up 30%, and the other 493 companies are taking up the rest of the 70%. That is just massive concentration risk in those top 7 companies. So the question is not, is AI going to reshape the economy? We're starting to see that it will. The question is whether the current valuations of all of these companies reflect realistic timelines for returns on those massive investments. And history tells us transformative technologies often take longer to generate profits than markets initially expect. In the dot-com bubble, this is the perfect example to think about, because as we went into the dot-com bubble, everything became a website or trying to utilize the internet to create business opportunities. And while a lot of those companies failed, we did see companies like Amazon come from that and really change the way that we think about the way we live our lives today. The economy continues to expand, but at a more moderate pace. After a brief dip in early 2025, GDP rebounded strongly with 3.8% growth in the second quarter. Globally, the IMF projects around 3.1% for 2026, which is steady but not spectacular. What's notable is the unevenness, though. Some sectors and income groups are really thriving, while others face challenges. It's what economists call a K-shaped recovery. The big question for long-term growth is productivity. If AI and new technologies truly boost how much workers can produce, that supports both economic expansion and corporate profit margins. When we think about economic growth, GDP in particular, it's made up of really 2 inputs: the amount of labor you have and your amount of technological advancement or technological productivity improvements. And so there's a lot of opportunity as technology improves. It allows labor to be more effective in what they're doing, which ultimately creates long-term economic growth. Tariffs drove a lot of the market volatility in 2025, and I don't think that really needs to be said, but their impact has been surprisingly muted. Despite tariff costs rising to 10 times the historical levels, inflation barely budged. Why is that? Many tariffs were paused or reduced. Companies absorbed costs or imported goods early, and strong consumer spending and AI growth offset a lot of the drag on the economy due to tariffs. So what's the lesson here? Tariffs are a policy tool that will continue to be used, but their daily impact on markets may diminish as we move forward and begin to adapt to what a new normal might look like. Between the midterm elections and ongoing fiscal debates, Washington will dominate the headlines again in 2026. We saw a 43-day government shutdown in 2025, and budget concerns aren't going anywhere. Just because government reopened doesn't mean that politicians are doing anything for us. And the recently passed tax legislation provides some clarity, but questions about government funding and the national debt, which is now over $36 trillion, will continue to persist. Here's what history tells us about midterm elections years. They have averaged solid annual returns of around 6.8% since 1933, speaking about the S&P 500 in particular. And more importantly, trying to invest based on political concerns is really a terrible and historically losing strategy. So what you can control is understanding how new tax provisions affect your planning, from lower rates to estate tax exemptions and SALT deduction changes. The Federal Reserve resumed rate cuts in 2025 and will continue to adjust policy in 2026. But there's a new wrinkle, and that's Fed Chair Jerome Powell's term expires in May, which opens the door for new leadership to be appointed by President Trump. The economy has performed well regardless of which party appointed the Fed chair. And remember, the Fed only controls short-term interest rates. Long-term interest rates, like those of your mortgage or the 20-year Treasury bond, they depend on growth, inflation, and productivity and are set largely by market forces. Focus on those trends rather than parsing every single Fed statement. Prior to really ultra-low monetary policy post-global financial crisis, people didn't pay attention to what the Fed said just at every single meeting, hoping for a hint of lowering rates as if it was going to spur the market to new heights. That has happened in recent years, but it hasn't historically been the case. And so we want to make sure that we're focused on the bigger picture rather than the minutia of the Fed statements. So where does that leave us as we start 2026? Markets have delivered strong returns, but elevated valuations and moderating growth suggest that we should temper our expectations. The catalog of worries is always present, but history shows that for every actual crisis, many more feared events never actually happen. What separates successful long-term investors isn't the ability to predict which concerns matter the most. It's the discipline to stay balanced through all market phases and position for multiple outcomes. So that is thinking about different scenarios that could occur and how do you position a portfolio to benefit through any one of them, not necessarily predicting the absolute best or the only case. So it's not always easy to do when headlines are screaming for attention, but it's what has tended to work historically and what investors could do well by thinking about going forward.